We will now begin the conference call, and for that, I'd like to introduce President Liz Bernhard.
Thanks, David, and good morning, everyone. Welcome to our first conference call of 2024. We're so glad you've been able to carve out this time to spend with us. For our regular listeners, you know the drill. We'll spend the next hour or so working to answer the most common questions we've been hearing from clients lately. And for our first-time listeners, welcome. We hope you come out of this call with more information and a better understanding of Albion's thinking on a variety of topics, and that you also choose to become regular listeners. As we heard from David, we do invite you to ask questions during the call. And generally, the easiest way to do it, if you're in the Zoom application, whether you're online or on the app, is to use the chat box feature at the bottom of the Zoom window and type your questions in there. You can also raise your hand either through Zoom or, as David indicated, if you've called in, you can use that *9 feature to virtually raise your hand, and that'll give you the opportunity to ask your question live during the call. We are recording this call today, and we will be sending out a link of the recording to all of our attendees. Please feel free to share that link with friends or family members, people who you think may benefit from hearing the conversation that we're having today. And also, please feel free to refer those friends, family, colleagues to Albion if you think they could use the help and the services that we provide. One more housekeeping item before we jump in. We are having our annual ski event this year. That will take place on Thursday, March 21st. It will be in Alta. Where else? It'll be skiing in Alta, lunch at the Snow Pine Lodge. So please mark your calendars. We hope you'll be able to join us. We'll be sending out an official invite and request for our RSVP via email in the next couple of weeks. So keep your eye on your inbox for that. If you'd like to join us, but you're not a skier coming for lunch, just lunch is a great option, and we hope to see you there. So as we launch into our questions, I want to start out with putting the first question to our newest panelist, Dani Gregory, who's a senior wealth advisor here. And I'm going to ask her to answer the most common question we're getting at this time, which is, when will my 1099s be available? And so, Dani, can you just talk to us a bit about, what we should be looking for in terms of documents, what we should be keeping in mind in terms of deadlines as we're approaching tax season, and just sort of some best practices, things to remember?
Thanks, Liz. Yeah, there are 3 big documents that you should be looking for from your custodians, and not everyone will get all of those 3 documents. The first one is 1099-Rs, which are for retirement accounts. Most of those have been issued at the custodians, but you will only receive a 1099-R if you took a distribution from your retirement accounts. If you have not taken any in 2023, you will not be getting one. The second document is the regular Form 1099. This is for all taxable accounts. These will be coming out. There is a wave that already has come out. The rest are expected to come out in the next week or so. Anyone with a taxable account will be receiving one of those. And I would also watch out for, sometimes they issue a corrected 1099 a couple weeks later, and you want to give your CPA the most updated form. And then the third document to watch for is a 5498, which that shows IRA or Roth IRA contributions. However, custodians do not issue that till after the tax filing deadline, because you have until then to make the contribution. So when it comes to retirement account contributions, make sure you're just telling your CPA what you did for 2023. In other kind of deadlines that are coming up, the big ones are those retirement account contributions and HSA contributions. You'll want to make those by April 15th. Preferably, we don't love it if you do it the day of. So trying to kind of plan ahead for that, but we do like to say we're miracle workers sometimes, so we will do whatever needs to be done, but those are kind of the big things. And I would definitely, the tax forms that you receive from the custodian, those are the ones that you want to give your CPA, because they report directly to the IRS.
Thanks, Dani. And I'll just tack on, we've been seeing a lot of people doing qualified charitable donations from their IRAs using their required minimum distributions, QCDs. Those do not get reported on any tax documents, so that won't show up on your 1099-R that Dani referenced. So if you are someone who's been doing those, we try to work with you throughout the year and your CPA to make sure that you have the documentation you need to report those for your taxes. But just know you'll want to give your CPA the heads up or note those if you're doing your own taxes, because they won't be sort of baked into the 1099 document that you get from the custodians. Thank you, Dani, for that. Now we are going to shift into sort of the economy and markets portion of the call, which is where we tend to spend most of our time on these calls. And I'll bring in our other panelists, Jason Ware and John Bird. Before we do kind of get into the meat and potatoes, I just want to sort of set the stage or give some high-level information about some of these sort of key economic pillars that will be part of the conversation today. And I'm going to start off just talking about where we are with interest rates. So we saw interest rates really peak in the middle of last year. We saw the Fed funds rate hit its high mark in July of last year, and that's where it currently sits, around 5.25% to 5.5%. A question that we've been getting a lot and we will dive into today is, when are we going to see rates come down? When are we going to see the Fed start to cut rates? So stay tuned, more to come on that. I do want to note that the yield curve is still inverted, and what that means is that we're earning more interest on our short-term debt investments than our longer-term debt investments. And the curve has been inverted since August of 2022. And why we care, or why that's something that's talked about often, is the inversion of the yield curve has historically been a really good sort of leading indicator of recession to come. And one of the questions that we'll work to address today is, what's Albion's stance on recession? Certainly there was a lot of questions about that last year in 23. It's still on the table. Is that something that we're looking down the road at in 2024? Moving from interest rates to inflation, although inflation is not the first word out of everybody's mouth anymore, it's still a relevant topic in economic discussions. And we saw inflation on average at about 4% in 2023. And we just got the CPI number for January of this year yesterday, the Consumer Price Index information, and we saw year over year prices went up about 3.1%. So we're still not at the Fed's 2% target. There's a lot of questions about, what will it take to get there? What are our thoughts on inflation? And I know our panelists will have details and thoughts to share and insights there. The labor market and jobs is another topic that we'll want to discuss, and it remains strong. We saw over 2.5 million jobs added in the US in 2023. And on average, wages grew about 4.7% last year. So what that means is that workers are experiencing real wage growth, or they're seeing their purchasing power increase, as on average, their wages are going up at a rate greater than inflation. And this sort of strong labor market trend is continuing into 2024. We saw over 350,000 jobs added in January alone, which was higher than what was anticipated. And so we know an employed consumer and a consumer who's experiencing real wage growth, they're going to be a more confident consumer, likely going out and continuing to spend in the economy. And as we've talked about on these calls, consumer spending makes up about 70% of the US economy. So key component. On the topic of the economy, it grew last year at a rate of about 2.5% as measured by GDP. And GDP is gross domestic product. And essentially, it's the total market value of all final goods and services produced in the US, as we refer to US GDP. And we'll get more into, how the economy is doing, what we saw last year, and what we think we'll be seeing in 2024. And so with that sort of context background, I'm going to just dive right into the questions. And while we're on the topic of the economy, Jason, I'm going to ask you to chime in on this first question, which is, I shared the 2.5% GDP growth rate, but can you give us some context on that? Obviously, that's just a headline number. What are we really seeing both last year and what are we thinking is ahead in 2024?
Yeah, so good morning, everyone. And Liz, thanks for that preamble on the economy and the macro. The economy, generally speaking, is doing fine. It's doing better than fine, really. It's quite robust, as you outlined. In the last 2 quarters of 2023, so really the second half of the year, growth ran at a pace at just over 4% annualized, which is a pretty healthy pace of growth. That was actually an acceleration versus the prior 4 quarters. So under the hood of that, we see the consumer is still spending, we see the businesses are still investing, and government budgets are still additive to growth. We're still seeing like a pro-cyclical tilt to fiscal policy. All of calendar year 23, as Liz mentioned, we saw growth about 2.5% over 2022. And that was a pickup from growth in 2022 over 2021, which was about 1.9%. And so, for context, and as has been kind of coherent with our getting back to normal theme that we've talked about the past couple of years post-pandemic, the velocity of growth at this point in the economy is kind of in line with the pre-pandemic 10-year average, which was around 2.25% per year. Now, to be clear, this is all backward-looking data. So as we look at more current information, things like spending data from the credit and debit card companies and the banks, retail sales, service PMIs, jobless claims, corporate earnings, even rising consumer confidence as of late through like the Michigan Index and through the Conference Board's Consumer Confidence Index. All of these things suggest that the economy so far in 2024 has continued with the momentum we saw as we exited 2023. So the economy is still in good shape.
Thanks, Jason. And, one of the sort of buzzwords of 2023, I don't know if buzzword is the fair term, but certainly we're seeing, it continues to be the hot topic, is AI and the impact of AI, not just on the markets, but also the economy. How might we see AI impact the economy this year and contribute to any, growth?
Yeah, great question. Certainly topical. And in AI, there's been a lot of ink spilled on this question ever since ChatGPT went mainstream. I guess that was November of 2022. Our view is that AI has sort of made everyone a technology company. You either make it or you use it. And if you don't use it, you lose it. That is, you go out of business. I think many of you have heard me say that, for example, like AI won't replace doctors, but doctors who use AI will ultimately replace doctors that don't. And that's kind of the way that we think about the impact AI can have on the economy and in particular on the jobs market. What's interesting about AI, though, specifically, is that it really focuses on augmenting the brain. It used to be, technology used to be more about augmenting the brawn of humans. And now we're talking about augmenting the brain of humans. And the potential of that is awesome. I think, most technologists, most economists would agree, there's a lot of opportunity there. So for us, when we add up like the pluses and minuses of AI, and certainly there are, arguments on both sides, we think that, technology and in particular the newfangled story of AI, even with that awesomeness, will kind of prove to be a tale that we've seen before. And we talked about this last year on a couple of our conference calls. And that is a tale of like one of a new efficiency, which is often technology led. It doesn't mean that people are going to lose their jobs in mass. There's always churn in our labor market, and that's actually healthy from a macroeconomic perspective. But most folks who get caught up in the AI transition will get reskilled. They'll find other jobs reasonably quickly, often better jobs, which kind of pushes up overall progress. So that's a good thing. We think that technology like AI largely enhances productivity of workers, which kind of allows the economy over time to grow more quickly and without those, undue inflationary pressures that we've all been dealing with for the past couple of years. So on balance, as we kind of look at the structural underpinnings of the economy, if we don't have productivity growth, the labor force has only been growing at about 1% a year for the past few years. So that's really all we have to look forward to in terms of real economic growth if there's no productivity growth. But the good news is that companies and entrepreneurs are aspirational. They're going to use technology like AI to boost productivity. There's no doubt about that. It's already happening. We're seeing it happening across the board. And we've seen US productivity step up over the last few quarters, in part because of the investments in technology we saw during the pandemic, also in part because of the AI boost that we've seen over the last year or so. In fact, productivity last year grew at about 2.7%, which is the fastest pace in 3 or 4 years. So things are showing up in the economy in terms of technology and AI. Part of that is, like I said, the technology story. Part of it's also just the notion that people are staying in their jobs longer now. So the longer you stay in your job, the more productive you become. We're seeing that through labor market indicators like the quits rate, for example, which has come down. Overall, we think AI is a tool to drive progress forward, so we're pretty optimistic about it. And of course, there's a lot of exciting investment opportunities around AI as well.
Liz, I'm going to throw something out there with regard to AI. And Jason, I absolutely agree with what you said. And I've watched the evolution of mainframe computers through personal computers, through the internet. And so many of those helped us, supplemented our memory and our ability to organize data. And now we're in the AI space. A concern that we see often in the AI space is fraud, in that you can misrepresent what others are saying or doing, which to me circles us back to that human element where you do need people who are looking at this information that's out there and actually vetting it and trying to dig into the sources to make sure that you're truly making your decisions based on good, real information, as opposed to potentially AI fraudulent information. And while that's just a small piece of the overall use of AI, it certainly is one that Dean's watching and that we watch out for in our decision-making process.
Thanks, John. The job market, Jason, you talked about jobs, you talked about labor market and increase in productivity. Talk to us a bit about what we're seeing in the labor market and with jobs. I mean, I shared in my intro that it's, we're certainly still seeing strength there. Is that widespread? I mean, we've also heard about a lot of layoffs as of late. And, are we seeing strength in certain pockets and not in others? Can you dive in a bit on the details there?
Sure. So, the truth is the economy is strong because the jobs market is strong, and because the economy is strong, that keeps the jobs market strong as business profits support employment and wages. It's like this virtuous loop. Now, that said, we are seeing some signs of labor market normalization, which is a good thing. And that kind of speaks to the specifics of your question, which is, we're seeing some pockets of weakness, some pockets of layoffs. We've almost had a rolling recession of sorts over the past couple of years, where we've seen some sectors that have been in a slump and have therefore reduced jobs, while other sectors have kind of carried the load and been adding jobs. And overall, on balance, as you mentioned, the most recent jobs report looks strong. Last year, we added a couple million jobs. The year before that, I think it was 4 million. So the labor economy is certainly helpful and healthy to economic growth. And I think that normalization theme is an important element that we have to keep in mind. And kind of what normalization of the job market means in English is better balance being restored to the labor market after a couple of years of what can be best described as like pandemic weirdness. More specifically, we can see in the data that demand for workers has softened. Even though we're still seeing strong job ads, the demand has softened. We can see that through things like the JOLTS report, which has come down. We had a record 12.2 million jobs that were available last year, I think was the high watermark, and now it's down to about 9. So we're seeing some of that demand come down, which is good. 12 million is far too high. It's far too tight of a labor market. Meanwhile, the supply of workers has come up, which is, I think, is a less discussed element of that restoration of balance in the labor market. We saw over 600,000 people come back into the labor force last year, which of course is a good thing. And of course, all of this helps kind of take strain off of employers. It reduces that labor market tightness. It creates better equilibrium. And within this context, layoffs have remained low while hiring has kind of remained steady, even better than expected. You mentioned the jobs report last month, which was pretty strong. And I think until this changes, things in the economy should be on balance, pretty good. And that'll be the big question over the next couple of few quarters is, will the US labor market go from really tight to even out without swinging that pendulum negative. And for now, even though we have some areas of softness in the labor market, overall, we're still seeing pretty robust jobs growth.
Okay, let's move on to inflation and talk about what we're seeing in inflation. We've certainly seen it trend in the right direction, although it kind of seems sticky from here, getting down to that target 2%. What are we seeing with inflation? We just got that CPI report. Anything under the covers that's notable or more informative than just the number, the headline number? And what do we think, as the course for 2024, and as we steer into interest rates from here, how the Fed may react?
So directionally, the pace of inflation, that is the rate at which prices are going up, not price level, but the growth rate of inflation, that's cooled dramatically over the past 19 months. I think everybody's aware of that. Liz, you talked about that a little bit. We've largely solved about 2/3 of the inflation velocity problem. We were at 9.1% inflation at the peak in June of 2022. We're now down to 3.1% as far as like headline CPI is concerned. There's other ways to measure it, but largely speaking, we're somewhere between 2.5% and 3.5% in terms of inflation. And of course, that's a good thing. But as Jerome Powell likes to say, more work is needed before we can declare victory on inflation. And we tend to agree with that. The Fed's target is around 2%. So inflation for over a decade prior to 2021, when things started to heat up, was below 2%. I mean, the Fed had a really hard time getting inflation up to 2%, despite all of the QE and monetary policy easing that happened in the 2010s. So I think realistically, we probably need to shed another 0.5% or 1% off of our current inflation stride and do so in a consistent manner, which is something the Fed has talked a lot about, before feeling confident that we can truly be back in a good place. So stable 1.5% to 2.5% core inflation is a sign of a well-balanced economy. So that's something that we could certainly all shoot for and hope to get there. And we think that we will get down there eventually. I think looking at inflation under the covers a little bit, we had the most recent CPI report. 2/3 of the inflation that we're still experiencing in the economy is being driven by shelter costs. That is rent and kind of a wonky statistic that the government uses called owner's equivalent rent. And I won't spend a lot of time getting into that. But the point is, we've seen shelter costs go up dramatically during the first part of the pandemic, and we're only now seeing that begin to normalize. And as that comes down, and those shelter costs do work with pretty long lags, we expect in the months to come, shelter to continue to come down. In the most recent CPI report, shelter was up a little over 6% year over year on balance. That's OER and rents. Historically speaking, if you look at the 40-year average prior to the pandemic, shelter costs ran at about 3.5%. So we do think that as things kind of settle in, that will track lower and that will continue to take inflation pressure off. And I think there's decent odds, assuming the economy doesn't reaccelerate or the jobs market doesn't become tighter again and wages start going up, or if we don't have an exogenous shock, of course, which can always impact prices. Assuming those things don't occur, so maybe we get a little lucky, we expect that inflation will track lower and we'll get down close to target. I'm not sure 2% is realistic. We're kind of thinking of 2% as a floor as opposed to a ceiling in the prior 10 years, but we do think inflation's moving in the right direction.
I agree with all that, Jason, of course. And I think it's important to separate out deflation from slowing inflation. And that I read a lot in the press about, well, gosh, I want prices to go back to where they were 3 or 4 years ago. That's not going to happen. That's deflation. And actually, that's really dangerous for an economy. So I think for all of us to understand that inflation may, hypothetically, it trends back to 0, but that doesn't mean the prices go back to where they were 2 or 3 or 4 years ago. This is our new baseline. And any inflation is actually from this current baseline. An important distinction, particularly as we're looking and to try to understand the metric of what inflation's been doing to the economy.
It's a great point. If I may add one thing to that. So I think it's reasonable then ask, well, if prices don't go back to where they were, or if we don't see some, respite there in terms of what I'm spending at the grocery store or anywhere else in the economy, how do I ever get ahead? And that goes back to Liz's comment early on about real wage growth. So the good news is that we're seeing real wage growth, and that also ties into productivity. It ties into AI. You can put all of these macro elements into one like soup. And the reality is they're all important and it helps real wage growth. And if your wages are growing faster than inflation, then over time, you're able to progress and get ahead, if you will. So the good news is we are seeing that because we have a healthy labor market.
Okay. Moving into interest rates and where we are with interest rates. I mean, certainly there's been a lot of anticipation about will the Fed cut the Fed funds rate this year? We have yet to see that happen. That's a big question for people. When is that going to happen? And certainly we don't have a crystal ball. We don't know. But what are we seeing with interest rates? What do we think is potentially a likely course for 2024 with rates? And then also talking a bit about, and we can all chime in here, how that impacts the types of investments we're looking at.
Yeah, so I'll lead off. So on this call back in July, we said the Fed was done hiking. Be it either lucky or good, that view proved correct, at least so far anyway. Today, we continue to believe that the Fed has no reason to raise interest rates further. The Fed itself and financial markets have largely come around to the same view. As Liz mentioned, we've gone from 0% to almost 5.5%, which, by the way, is a ton of credit tightening over the past, almost 2 years without an increase in unemployment. So job well done so far. So it seems the more relevant question now is how long will the Fed stay up here before cutting rates? That's what everyone seems to be focused on. So far, it's been about 7 months from their final hike in July through today. The historical average of the plateau in interest rates is closer to 9 to 10 months. So maybe there's a little bit of time left. Obviously, that's just using history as a guide, not a prediction. But we think going forward, the answer to when the Fed pivots will largely depend on the path of the economy and the path of inflation. So there's 3 possible outcomes, and I'll hit on them real quick. If a recession soon hits, the Fed will have to ease policy, both because unemployment will surely rise and inflation will fall. And they may have to ease aggressively. And the good news is they have room to do so because they're up here at about 5.5%. So there's room to cut. The second possibility is the economy holds up, but inflation continues to drift lower towards the Fed's target. And under that scenario, the Fed could also cut, but just not as quickly and probably not as much, because if inflation's coming, the Fed cares about real interest rates. And if inflation's coming down and they keep their Fed funds rate at a nominal 5.5%, then all things equal, credit conditions get tighter on a real basis. So the Fed could track inflation lower to keep financial conditions consistent and steady. And then the third path is the economy holds up and inflation stalls out here in the 3% zone, or worse yet, things reheat, which might lead to no cuts for a while, or maybe even another hike or two. So as we think about those 3 different paths, those 3 different possibilities, we think that path 1 or path 2 is by far and away the most likely. Path 3 is highly unlikely, but time will tell. So the Fed's likely to cut here at some point, maybe mid-year, we'll see. And everyone's watching, of course.
Everyone is watching.
Yep. And as we look at the yield curve, where, as you highlighted in your opening remarks, Liz, longer-term interest rates are lower than short-term Fed funds rates, which suggests that the market does expect both inflation and rates to come down, partially due to what the Fed is doing to get inflation to come down. That is what a 10-year Treasury bond interest rate, for example, is an estimate by the market of all the players of what they think the rates will be over that time horizon. So there is still a sentiment that rates are moving in the right direction. And Liz, you just muted yourself.
Thank you.
You're welcome.
Let's talk about recession and Albion's outlook on recession. Jason, you referenced recession in your remarks, and John, when we talked about the inverted yield curve, certainly that can be an indicator of recession. What is Albion thinking and seeing in terms of possible recession for 2024 or in 2024?
Sure, it's an important question. So I won't bury the lead. Are we still anticipating a recession this year? Yes, we are. Though at the same time, we think soft landing odds have gone up too. When our forward indicators signaled the most caution, which was about a year ago, it was early 23, recession odds through our model were said to be quite high. Several of these indicators have improved in the time since, meaning recession probabilities have come down. But because the two highest quality indicators continue to flash red lights, and both John and Liz have mentioned one of those indicators, that's the Treasury yield curve being inverted, the other one being the Conference Board's LEI, which is their leading economic index, which is an index of 10 sub-leading indicators that we think is pretty comprehensive. But because those two elements are still flashing red, we consider a recession risk to still be elevated. Also, the idea, and I've talked about this on prior calls, the idea that the Fed can take rates from 0% to 5.5% with over $1 trillion in quantitative tightening, all in a very short period of time, and that the economic pendulum will stop from strong growth to perfect growth without going negative. It doesn't make a whole lot of sense to us, and it would be somewhat ahistorical to expect that. That doesn't happen often. In any given year, the risk of recession is about 15%. So recession is always a possibility. Right now, we'd say the odds are maybe 50-50 based on the data that we're seeing. But again, there's been some diminution of that from a year ago. The odds were higher a year ago based on kind of what we were seeing at the time. So we've seen some improvement, but the odds of a slump are still uncomfortably high in our view.
But absolutely, and yet there are indicators that suggest that reduce those probabilities. Initial jobless claims have diminished, and they're at a steady rate right now of about 200,000 a week. Corporate bond spreads, which really are an assessment of what the market thinks the risk of default is among corporate bonds, have tightened, and that they're steady at a much tighter level, meaning you're not getting a whole lot more yield if buying a corporate versus a treasury, which suggests the market has a positive outlook. I think Liz already addressed, and I think Jason already addressed, consumer confidence, which is stronger than we would have expected right now. It did rebound toward the end of 2023 into early 2024. So absolutely, the Conference Board issue and the inverted yield curve are suggestive of the potential for recession. It's conflicted messaging. There are plenty of indicators out there that are suggesting that the economy is doing okay as well.
Yeah, worth mentioning that each one of those indicators are in the forward-looking Albion dashboard that we use. And to John's point, those are examples of those indicators that I alluded to that have improved over the last 12 months, while LEI and Treasury yield curve have not. And therefore, why our implied odds of recession have gone from very high a year ago to, like I said, maybe 50-50 at this point. So things have improved. So I agree.
I want to circle back just to the interest rates for a minute and talk about as we see rates, or when we see rates start to come down, how that may impact investments, and what we how we do asset allocation in client portfolios. And we've talked about this several times in other calls, but I think it's always worth reviewing. So as interest rates comes down, it cuts both ways, right? It cut in terms of what we would have to pay for a mortgage or other debts. That interest rate also tends to come down. But then what we're earning on our fixed income investments also comes down. And so as we're looking at, the potential for interest rates to come down this year, how that impacts the types of investments that we're owning for clients. I mean, from the sort of the most easily impacted and viewed the investment being a money market position, which is, very correlated to the Fed funds rate. We'll start to see the interest rate on our money market positions come down. We'll also see the interest rate on what we can get for the interest rate that we can get on corporate bonds and other types of bonds will start to come down as well. So as we're looking across, fixed income investments, as we see rates coming down, we'll also see, the interest we can earn on those types of investments coming down. Okay. So moving on from interest rates, it probably surprises no one that 2024 is an election year, and we've already been hearing quite a bit about that. How does an election year impact the markets? Does it matter, what party is in power, and in terms of how well the markets perform? Without getting too political, just kind of want to share some information on, what do we see in an election year in general, how it impacts the markets, if at all?
Yeah, I'll jump in on that. Great question, timely question. We like to say don't mix portfolios and politics. Not only can it lead to suboptimal decision making based on passion and emotion, but the fact is the outcome of any given election in any given year just simply doesn't matter much to the stock market. Typically, the person sitting in the White House, and I've said this many times before, the person sitting in the White House gets too much credit when things go right and too much blame when they go wrong. That's typically kind of just how it goes. Instead, millions of daily decisions, the vast majority of which, by the way, are apolitical, repeated over and over by consumers, businesses, and investors. Those are the things that determine where the economy goes, what business profits look like, and the valuation multiple placed on stocks. In some years, this all works to reduce stock prices, like we saw in 2022. In most years, these things are a tailwind. In fact, history shows that in most years, roughly 3 out of 4, they're a benefit to stock prices. They move in the right direction. And election years are no different, with most of them being directionally positive. And you can go back, over 40 years, 50 years, 100 years, and look at stock market returns in election years. And the average is a little bit lower than the long run average, but it's not lower by much. Finally, I would make the point, that's the macro view. I want to make the point about the micro view. Good companies don't really care who's in the White House or what tilt makes up Congress. At the margin, it can certainly have an impact. But in our analytical model, we just ask a simple question of does the person who occupies 1600 Pennsylvania Avenue really have a material long-term impact on the earnings and cash flows of Apple or Microsoft or Costco? And we can certainly create extreme scenarios where it could, but probabilistically, which is the soup we swim in as investors, history is quite clear on the answer, and that answer is no. Good companies survive and thrive based on the products and services they sell, how they allocate capital, invest, how they manage their resources. I mean, that's 99% of the ballgame when you're looking for good investments. It's why Google stock is up over 5,000% since going public 20 years ago, despite 5 presidential elections and 4 different sitting presidents, not to mention midterm elections and local elections and more. So it just doesn't really matter to strong businesses. So that's how we frame election years with markets and portfolios, is just ignore the noise, own good companies, own good investments, and think and act long term.
Right. To paraphrase several others who have used this in a different context, what do you get when you mix politics and investing? You get politics. So we have to keep it separate. And we have to focus on, as Jason said, what are the companies we own? What are they doing? How are they treating their customers, their consumers, their suppliers? And are they likely to continue to thrive and prosper? And that has to be the basis of our investment work.
Thanks, John. Jason, you mentioned own good companies, and certainly we're probably wrapping up earnings season and hearing from how companies did in the fourth quarter of 2023. Can you talk to us a bit about, what are we seeing with the health of corporate America, if you will, and, insights that are coming out of earnings season, and sort of what is that telling us about, valuations in the market?
Yeah, great question. So, there are several ways to assess corporate health. There's the balance sheet view, which is assets versus liabilities. There's through the income statement, which is profits and losses. Both lenses suggest, both in this most recent quarter, but also throughout 2023 and even most of 2022, that business conditions remain pretty much on a solid footing, is, I guess, the simplest way to describe it. Generally speaking, asset values are up, cash balances are high, and as we mentioned with interest rates, those companies are finally earning a return on their cash. So for those companies that have a lot of cash, that's been beneficial. In fact, there have been some analyses done that showed that the net cost of debt, when you look at the rise in interest rates, but also the money being earned on cash, that the net effect of that has been that real costs are lower for companies that are cash rich. And the good news is that we favor companies that have strong cash positions. So that's been good. Liabilities, namely corporate debt, are still benefiting from locked-in rates, locked-in lower rates from years ago. And I want to be clear, this isn't true of every company. There's certainly dispersion between large and small business, across sectors and industries, even location considerations when we're looking at companies. But in the aggregate, American companies are well run and they're thriving. That said, kind of getting into earnings and specifically what we've seen over the last few weeks with earnings seasons, when looking at the S&P 500 as like a cross section of corporate health, profits in 2023 were at about the same level they were in 2022, so no growth. Now, again, there are, of course, differences sector by sector and company by company, but the sum total of earnings produced over the last 12 months were flat versus the prior 12 months. Now, why is that? We just talked about the economy strong. How can that be? Well, primarily due to profit margins. Revenues were up strongly in 2023 because, again, the economy was growing. So we had, nominal GDP pushing revenues up, but we also had price hikes because of inflation. So revenues looked good last year. But costs were also quite elevated for businesses as well. And in fact, in most cases, costs were higher than revenues. So that resulted in margin compression, which led to stagnant profits. And of course, where we go from here over the near term, we think will be a function of the macro economy. Wall Street analysts currently expect about 12% earnings growth this year in 2024 over 2023. In our view, that level of growth will require an economy that avoids recession and sees margin re-expansion. It's certainly possible, but it's not our base case. We mentioned that recession risks are still elevated. But regardless of the short-term assessment, whether it's like, how did companies do in Q4? How did they do last year? What we care about more is the longer run corporate health, and in particular, the corporate health of the companies that we own on your behalf. And the good news is that here we remain quite optimistic over the next 2, 3, 5+ years on the trend in the businesses that we own.
And Jason, those are great points, and it's also important to recognize that not all companies have the same results. Many of the ones that Jason has alluded to that are in our portfolios, they've actually have shown year-over-year earnings growth. An area that's getting quite a bit of press and concern these days is commercial real estate. COVID did change how we use that, and those companies that are investors and managers of commercial real estate are struggling, because a lot of people aren't going back to work. There's a glut of office space, and that's got to work its way through the system. There are certainly a lot of financing related to that commercial real estate that ultimately will not be repaid. So we're seeing those impacts both today and coming down the road into the future. And our perspective on those types of areas is, okay, how do we just make sure we're not in front of that train wreck and keep our portfolios positioned in areas outside of that potential for danger?
Thanks, John. We have about 15 minutes left on the call. I want to make sure we carve out some time and go through some of the planning questions that we've been hearing often from clients. So I am going to switch gears a bit and address some of those. Before I do, just John and Jason, or any other remarks you want to make on sort of the macro micro conversations we've been having? Okay.
Me.
So as we shift gears, a lot of the questions that we've been getting on the planning side have to do with the Secure 2.0 legislation that was passed at the end of 2022. Now, whether clients know that these questions really pertain to that legislation or not, who knows? But that's where it's coming from. There were some new provisions, some new options that were allowed under this legislation, and we want to address some of the ones that we're getting asked about frequently. I'll say that the Secure 2.0 Act is tax legislation that was really trying to address retirement security. And probably the number one thing that we've been hearing from clients that as a new option since that legislation was passed was the option to take money and out of a 529 plan and put it into a Roth IRA. And so I'm going to pass the mic over to Dani and have her talk to us about, what is that? Why, when would you do it? Why would you do it? How does it work? Are there things we don't know yet? What do we know? Dani, please take it away.
Yeah, so that definitely has been a very common question, and it just went into effect this year. So kind of the big thing is that you can now transfer $35,000 from a 529 to a Roth IRA. This is not something you want to do while your beneficiary is still in school. While you still have higher education expenses, but kind of something if you have a leftover balance in your 529s. There are definitely rules associated with that transfer. So you can't do the full $35,000 in 1 year. You are limited to the annual contribution amount to a regular Roth IRA, which, for example, right now is $7,000 a year. So if that stayed the same, it would take you 5 years to do those contributions. The other rules include you have to have had the 529 open for 15 years. You can't convert any money that you've contributed in the last 5 years. And what is kind of cool about it that I think are like good strategies is, someone that's just come out of college, they probably don't have $7,000 of extra income that they can be putting into a Roth IRA. I definitely didn't when I was 22, 23. And so that's a good way to do it. There also could potentially be some strategies of waiting till you're a little older and maybe you make too much money to make a contribution to a Roth IRA, because there are no income threshold limits on this transfer. So even if you're above the Roth IRA contribution income limits, you could still do it. And just to clarify, the Roth IRA has to be in the name of the beneficiary of the 529. So I can't take, if I'm the owner of the 529, I can't take the money and then put it in my Roth. I have to do it for the beneficiary of the account. There are some loopholes, but we don't need to get into that. And yeah, there's still a lot of questions that we don't know. Like all tax legislation, they like to leave a lot of things very vague. So we'll definitely learn more about it as more and more things come up and this actually is being put into practice.
Thanks, Dani. We've certainly had some clients reach out and ask about that. And it seems like if you're somebody who has, some leftover funds in a 529 plan, this could be a good option, and one that didn't exist prior to 2023. There were a few other sort of, I would call them Roth things, for lack of a better term, that came out of this legislation that it's probably worth educating our clients about, as we've been getting some questions both around different types of retirement accounts and also employer contributions to retirement accounts. Can you take a minute and talk to us about that as well?
Yeah, so one big thing is, not all of you are probably familiar with simple IRAs and SEP IRAs, but they're used for, if you own a small business or you're the only employer of your business, that sort of thing. They're kind of easy accounts you can open instead of a 401k. Historically, you have not been able to make Roth contributions to simple IRAs and SEP IRAs. You now can. They're kind of the last accounts that are finally, getting up with the times and letting you do Roth. So that's a big update. The second thing is previously for 401k contributions, all employer contributions have always been pre-tax. The employer gets to take a tax deduction. They usually vest over a certain amount of time, maybe 5 years, and they're kind of as an incentive to, hire employees and keep employees. One big thing now is that the employer contributions can be made on a Roth basis. Now, it's going to take some time for retirement plans to get updated for this option. So I bet if you went to your employer right now and said, I want to do Roth contributions, employer contributions, they're going to be like, we can't do that yet. But what is so big about that is it just more the ability to put more into that Roth tax bucket. How the taxes work on that, because the employer will no longer be able to deduct that deduction, is that contribution will be taxed as ordinary income to you. So that could be a negative depending on your tax bracket. But one thing that would be interesting to look at is, say maybe you don't think you're going to be at your employer for 5 years and they have a 5-year vesting schedule. Well, if you think that, you might want to have your employer do Roth contributions. And since you have to pay the tax, you are immediately invested for those assets. So you will not give up those contributions. So those are kind of strategies that, talk to your advisor about, but I definitely think it's a great option and allows a lot more flexibility. And those are kind of big things. There's a lot of things in the Secure 2.0 Act, but I don't want to bore you with tax legislation, but you can always reach out to me if you want to be bored by that. So.
Thanks, Dani. And yes, please do reach out to us if you have any questions about these items or how they may pertain to you. We do have many clients who have gone down the route of opening a SEP IRA or a simple IRA. They're, self-employed, or they run a small business, and that's the type of retirement account that they choose to use. And those Roth features, especially now, are really nice. So it'll be, we're anxious to talk to people about that and how it may apply to their situation. The other topic we've been talking with clients a lot about, kind of moving away from retirement savings, is estate planning. And we've had a lot of clients reach out and say, I'm reviewing my estate plan, what makes sense? And it seems that one of the things that are kind of prompting this review at this time is the fact that we know that at the end of 2025, the current exemption amount is going to sunset. And what that means is right now you can pass a certain amount of money during your lifetime or at death tax-free. So you can give money away during your lifetime and or when you pass away through your estate, and that amount that you can give away before being subject to estate tax is currently $13.61 million, and times that by 2 if you're a married couple filing jointly. And to the extent that you give away assets either during your lifetime or at death in excess of that amount, then you become subject to estate tax, which currently is about 40% at the federal level. And then depending on where you live, states have different rules regarding that. And so if Congress doesn't act, because this is a tax legislation thing, the exemption amount will go down from that current $13.61 million to about $7 million per person. And so this potential reduction in that exemption amount is triggering people to look at their estate planning documents and make sure that they're written in such a way that accounts for potential changing legislation, and B, taking advantage of the current exemption amount if that's appropriate for their specific situation. There's more to estate planning, though, than just saving tax dollars. And I would argue for the vast majority of us, the big value in estate planning is really having the opportunity to express your wishes for what you want to have happen to yourself, your person, and your property when you're no longer able to act or speak for yourself. And so, Dani, can you talk a bit about, what is estate planning? Why do we have clients do it? I mean, certainly estate planning is up there with budgeting. It seems like it's the thing that clients really don't want to do. And we understand that. It's not necessarily thinking through the most happy thoughts, but, what should clients be thinking about? What should they be doing, regardless really of tax?
Yeah, everyone should have estate planning documents. That's the first thing I want to emphasize. And if you work with me directly, I'm consistently harassing everyone about that. But it doesn't matter if you don't have children, if you maybe don't own real estate, you need to have estate planning documents. The biggest things, the first I kind of always go to is you need to have a will. A will is going to state what your wishes are if you were to pass away. So, you have assets that, where do you want them to go? You have children, how, who do you want to name as the guardian? All those sorts of things. From there, the next document that I always recommend is advanced healthcare directives, which basically you're stating your wishes if you were to become incapacitated or if you are at the end of your life. So life-sustaining efforts, things like that. Those you can actually, in most states, find online and fill out yourself. You don't have to go through an estate planning attorney to do that. And what we recommend is fill those out, choose your agents, give your agent a copy, and also give your primary care physician a copy. And send us a copy if you want. So, your agent can come to us if they need it with likewise with all estate planning documents. The next documents that I really recommend are powers of attorneys, and there's kind of different flavors of powers of attorneys, but there's healthcare power of attorneys, which if you're incapacitated, someone being able to, make decisions on your behalf. And then there are financial powers of attorneys, which, same situation, if you're incapacitated, that they can help others pay your bills or access bank accounts, things like that. It really is very common for at one point in your life that those documents are needed, and it may not be like at the end of your life. And so having those in place are really, really important. Another big thing that you'll hear about is trusts. And there again are tons of flavors of trusts. That doesn't necessarily, not everyone has to have a trust. The value of a trust in extension of a will is a will goes through probate court, and not everyone wants that to happen. A trust can override what the will says and can skip probate. So essentially, whatever you have in a trust document, you can clearly state your wishes. You can be very, very specific, and that will skip the probate process. For example, I personally do not have a trust. I have the other documents because I don't own real estate. And I have all of my accounts, all my investment accounts, all my checking accounts, everything. I have beneficiary designations or transfer and death designations, which will skip probate. So you can kind of talk with your advisor of like what makes sense for you. But then to kind of touch on that, if you do have these documents, please review them on a regular basis, at least once every 5 years. You would be shocked the things that we see either on beneficiary designations or estate planning documents. I have seen ex-spouses still listed as primary beneficiaries. I've seen strangers accidentally listed in estate planning documents. I've seen people, that are already passed away, or, you have that, you've named that sibling that you've now learned is horrible with money that you don't want to name. So just keep up to date on all of that information. And then always remember on beneficiary designations for retirement accounts, life insurance, review those. We are constantly going to be looking at the ones that you have listed with accounts that are under our management, but we can't necessarily see what you have listed on like your 401ks with your current employer, things like that. So regularly update those, and those will override anything that you say in your will or your trust. Whatever is listed as your beneficiary designation, that is what will happen. So just make sure you're double checking those. It's very important.
Thanks, Dani. I have a couple of observations I'd like to make. One is sort of factual, one's anecdotal. The first is estate planning can get complicated quite quickly. And we have been fortunate over the last decades to work with several excellent estate planning attorneys. Most often they are incredibly helpful, especially when events occur, whether it's someone who is no longer able to conduct their own affairs. Unfortunately, deaths do happen. Having that estate planning attorney in the loop is incredibly helpful. I'm going to just share anecdotally my own experience with my family, where my parents went from being able to run all of their own affairs to, by the end, I was running everything for them. The trust was an essential piece of that. And with all the assets in trust, it's a fairly simple matter when I was named as successor trustee for my dad to resign as trustee. I became trustee. It was a whole lot easier than taking a power of attorney and going to every bank and every place where he had assets and saying, okay, I am entitled to make this decision. The trust remained intact. The trustee just changed. It was a much smoother process for helping them through their end-of-life process. So I actually applaud the estate planning and attorney who put that all together and helped us through that process. Many of absolutely everything that Dani said makes sense. The healthcare directives are very important. That came into play as well anecdotally in my own situation with my parents, where having those documents at hand helped. I got on a plane to go to Arizona because of a medical emergency. And by the time I got there, the Albion team had sent the documents to the doctor at the hospital where my dad was. So thank you, Albion team. You did come through when we needed it. And having those documents on file at Albion in that moment is super helpful. We have subsequently, and actually prior to that time, done that for a number of our client families. So when we have access to those, we can just be the grease when and if these events occur. Summarize, estate planning attorneys can be extremely helpful. I have really valued the incredible value add that they have created for our clients, and simplifying the process so as time marches on, whoever it is that's going to help those aging parents or friends, have them in position to be able to do that as seamlessly as possible is a really wonderful thing to do for your family.
Thanks, John. I think we've all had sort of personal experience with estate planning documents paying off, that we're so glad we had them in place, or that our family members had them in place. One note, part of what made John's parents' trust work seamlessly is that they titled their assets in the name of their trust. So that's a really key point. You can have a trust, but if you don't title your assets in the name of your trust, then they're not governed by the trust document, and it is not as seamless. So if you have questions about your own personal estate planning, please don't hesitate to reach out to us. We aren't attorneys. As John said, we work with wonderful estate planning attorneys, but we can also be a sounding board or a first stop on your way to meeting with an attorney to update or draft initial documents. We are at the top of the hour and want to be respectful of everybody's time, so we are going to sign off. I want to say thank you to everybody, and on behalf of the panel here with me today, thank you for joining us and spending this time with us. We will be doing 2 more calls this year. One will be in July, one will be in November. We are going to change up the times in which we are doing these calls to capture others who are not able to join us in this morning slot. Hopefully that doesn't impact any of our attendees today and your ability to join us on future calls. We will always record them though, so if there's one you miss, know that the recordings will be available. And also just keep in mind, as always, if there are people you think who can benefit from the type of market investing planning discussions that we had today, please send them our way. And with that, we will say goodbye. Have a great rest of your day.